When a hedge fund buys a stock, they might be right. When the CEO of that same company buys $1 million of their own stock with their own money, that's a different kind of signal. Insiders know things that analysts don't. They can't trade on material, non public information, but they can and do buy aggressively when they believe the stock is undervalued, and they're required by law to tell you about it within 2 business days. Welcome back to the AI Portfolio. I'm your host, a CFA charter holder with years of professional market experience. This channel gives everyday investors the same tools and thinking that used to be reserved for Wall Street. Free, every week. Nothing here is financial advice. This is a research skill. Let's build it. Here's how it works. Any officer, director, or shareholder owning more than 10% of a company is considered a corporate insider. Every time they buy or sell shares, they must file a Form 4 with the SEC within 2 business days. The filing lists exactly who bought or sold, how many shares, at what price, and what they own afterward. It's all public, it's all free, and most retail investors never look at it. Here's where to find them. The SEC Edgar system has every Form 4 ever filed, searchable by company or by individual. Sites like Open Insider and Insider Score aggregate these filings and make them easy to browse. You can filter by transaction type, dollar size, or whether the purchase was on the open market. Paste the filing data into ChatGPT or Claude and run the 3-prompt insider system. Prompt 1. The transaction classifier. Not all insider activity is equal. A CEO selling shares after a stock has tripled could mean anything: estate planning, diversification, taxes. But a CEO buying shares on the open market with their own cash at market price when the stock is down 30%, that's different. That's conviction. Use this prompt. Here's a Form 4 filing. Classify this transaction as a buy or sell. Note whether it was an open market purchase, an options exercise, a gift, or a planned 10b5-1 sale. Estimate the total dollar value of the transaction. Then assess whether this looks like a high conviction signal. Consider the role of the insider, the size of the purchase relative to their existing holdings, and whether they bought during a period of stock weakness or strength. The 10b5-1 distinction matters enormously. A planned sale set up months in advance tells you nothing about current sentiment. An unscheduled open market purchase tells you a lot. Prompt 2. The cluster detector. 1 insider buying is interesting. 3 insiders buying in the same month is a pattern. When multiple executives and directors from the same company all buy within a short window, they're not coordinating. They're independently concluding the same thing. That kind of independent confirmation is rare and worth paying close attention to. Use this prompt. Here are all Form 4 filings for this company over the past 90 days. Identify any period where 2 or more different insiders made open market purchases within 30 days of each other. For each cluster, note the total number of insiders, the total dollar value purchased, the roles of those insiders, CEO, CFO, director, and whether the stock price was higher or lower at the time of purchase than it is today. A cluster of buys where the insiders are underwater on the purchase, meaning the stock has gone down since they bought, is not a sell signal. It's often the opposite. They believed at a higher price. They still hold. That's staying power. Prompt 3. The context analyzer. Raw insider activity only becomes actionable when you understand the context around it. A director buying 5,000 shares looks different if the company just missed earnings versus if the stock dropped on broader market weakness. AI can read both the filing and the surrounding news in seconds and tell you which one it is. Use this prompt. Here is a Form 4 filing showing an insider purchase at Company X. Here's a summary of recent news and price action for Company X over the past 30 days. Analyze whether this insider purchase looks like a response to a company-specific event, broad market weakness, or appears to be unprompted conviction buying. Flag any red flags, such as the insider selling more shares than they're buying overall, or this being the first purchase by this insider after years of selling. That last flag is important. If a CFO has sold shares every year for a decade and suddenly buys, that's a pattern break. Pattern breaks are where the real signals live. Those are your 3 prompts: transaction classification, cluster detection, and context analysis. Together, they give you a framework for separating meaningful insider activity from routine transactions that don't tell you anything. One important limitation: insider buying is a bullish signal. Insider selling is almost meaningless. People sell for 1,000 reasons that have nothing to do with the stock outlook. Focus your analysis on buys, especially open market purchases by senior executives in meaningful dollar amounts. This is the final piece of the SEC document system we've built over the last few episodes. Episode 5 was the press release, controlled, polished, every word chosen. Episode 12 was the 10K, the deepest financial disclosure of the year. Episode 13 was the earnings call, management live and on the spot. Episode 14 was the 13F, where institutional money actually sits. And now Form 4, where insiders vote with their own wallets. Your homework this week: pick any company you're already watching. Pull their Form 4 filings from the last 6 months on Open Insider. Run Prompt 1 on the 3 largest transactions. See if any of them look like conviction buys. Post what you find in the comments. I want to see what you're watching. Subscribe if you haven't already, and I'll see you in the next one.